Hi, welcome to this my ninth and final data update for 2025. And in this update, I want to focus in on how companies return cash to their owners. In my particular case, because I'm looking at publicly traded companies, globally listed, I'm going to look at dividends and buybacks. Now, as I go through this session, there are two words that are going to come up over and over again. The first is inertia. A lot of companies pay what they did historically. They do what they've always done when it comes to dividends and buybacks. The other is Me-tooism. Many companies try to match up to their peer group defined by investment analysts and try to do what they do. So without a big lead in, let me start by looking at the two ways in which companies can return cash, dividends and buybacks, look at how much they return. But along the way, I want to give you a framework for thinking of how much cash a company should return as opposed to how much they actually return. And also present what I think is a clear and discernible shift, mostly in the US so far, but starting to spread across the world, away from dividends towards stock buybacks. There's a lot of mysticism about stock buybacks that I want to put aside and talk about what buybacks do, what they cannot do, and why companies might be moving towards buybacks. Along the way, I would report not just the dollar amount returned in dividends and buybacks, but scale it to market cap, which gives you a yield, and net income, which gives you a payout ratio. So with no further ado, let's look at the dividend decision. In corporate finance, there are three big decisions every business has to make. There's the investment decision, and we talked about in earlier data updates. There's the financing decision, which we've talked about in the last one. And finally, there's the dividend decision. Now, the best way to think about dividends is to think about a farmer sowing crops. Think of that as the investment decision. Then funding the land to buy the crops, a financing decision. But the end game, if you're a farmer, is not just watching the crops grow. That might give you joy, but in harvesting. The dividend decision is, in a sense, a harvesting of your success as a business. And in principle, at least, it should be the simplest of the three decisions. Why? Because dividends should be, at least in theory, whatever's left over after you've done your investing and financing decisions. It doesn't have the estimation uncertainties that go with investment decisions. It doesn't have the trade-off between tax benefits and default risk that should go with financing decisions. So in principle, it should be the simplest one. In practice, though, there is probably more dysfunctionality in the dividend decision than in any other aspect of corporate finance. Partly because returning cash to shareholders is letting go of cash for managers, and partly because of the psychology that somehow dividends are an admission of failure. I'm surprised by this. When I see companies report dividends and investors say, well, that suggests, your best days are behind you. That might be true, but what if it's the truth? There's no harm signaling the truth. So to me, the fact that companies pay dividends is not a sign of weakness. It's a sign that they've had successful businesses and now it's time to return the cash to investors. So let's start with what I call dividend utopia. What is dividend utopia? This takes dividends as residual cash flows and asks the question, how much should I pay out? So in this world, you wouldn't even start thinking about dividends till the very end. As a business, you look at your cash flows from existing operations, then you make a financing decision. How much am I going to borrow? And you add that on to your cash flows from operations. It gives you money to invest. So you make decisions on investments, and we know the principles there. You want to take good projects, and whatever you don't invest is then available to be paid out to shareholders. And we're going to talk more about this as potential dividends. Fancy word, it's whatever cash is left over after the investing and the financing decision are made. Now, that cash doesn't have to be returned. First, a company can decide to hold back on some of that cash. Builds up as a cash balance. Lots of reasons companies do it, good and bad. And some of it will get paid out. For a long time, the only way a publicly traded company could pay out that cash to shareholders was in the form of dividends. But increasingly in the last few decades, it's been supplemented, perhaps even replaced, by share buybacks. So in a utopian world, dividend decisions would be made last in the process of residual cash flow. The implications of that residual cash flow view of the world is dividends should vary across time, because if it's a residual cash flow, in a good year you should have lots of cash flows, in a bad year you shouldn't. So dividends should vary across time. And it also follows that investment financing and dividend decisions are connected. that what you make as investing decisions will affect how much cash you have left over. How much money you choose to borrow will affect how much cash you have left over. So when you go from year to year, you should expect to see the cash flows return to shareholders change. That sounds obvious. When we come back and look at actual dividends, we'll see why actual dividends might fail that test. So that's a utopian world. And in that utopian world, the way you compute your residual cash flow, what's left over, is you look at the cash left in the till at the end of the year after you've met every conceivable need. As I go through the sequence, don't think in accounting terms. Think about it like an owner. You have a checkbook in front of you. You've got money coming into your checking account, and now you're starting to write checks out. So you start with net income. I know it's accounting earnings. It's to equity investors. You add back depreciation, amortization. That gives you the total cash you have available to play with. What do you do from that? You take capital expenditures. That takes cash out of your checkbook. If you have to increase inventory receivables, more cash out of your checkbook. And if you borrow money, cash comes into your checkbook and you repay debt, cash leaves. This is very much a cash flow driven view of the world. Cash in, cash out. And what's left at the end is the free cash flow equity. It's a fancy word, but it's potential dividend. First, remember that number can be negative. Why would it be negative? If you start with a loss, you're in a hole already. You might end up with a negative cash flow. But you could be a money-making firm with significant reinvestment needs, new projects you're taking, new acquisitions you're making. You can end up with negative free cash flow equity. Or you can be a company with positive net income, not much in reinvestment needs, but a huge amount of debt overlay which you're trying to pay off, in which case your free cash flow equity can be negative. Dividend policy should get very simple then, right? If you have negative free cash flow equity, you should not be returning any cash. Companies violate that rule, but at least in the utopian world, it's a residual cash flow. It should vary from year to year, and you can calculate what it is right from the statement of cash flows, every single line item. Now, if you take that view of the world, you should expect to see your free cash flow equity change as you age. Now, if you've been watching my sessions, you know I'm very fond of a corporate life cycle where I take a company from startup all the way through liquidation. Let's play it through. Let's start with looking at the operating cash flows, the reinvestment, the debt financing, and the potential dividends at each stage. You're a startup, you start in the hole. You're losing money. You have huge reinvestment needs. You have huge negative free cash flow equity. You're a young growth firm. You're still probably money losing or very mildly money making. You have huge reinvestment needs. No debt, so that's not a problem. Still negative free cash flow equity. You start to enter growth, you're going to start to see your net income kick in and at some point turn positive. Your reinvestment needs are going to start to decrease because as your growth rate comes down, your reinvestment goes down. You might start to borrow money, but the money is coming in, not leaving, because you're going from no debt to some debt. Your negative free cash flow equity are going to start to become positive free cash flow equity. Your capacity to pay dividends just opened up. Now, if you're a mature firm, you're at peak cash flow capacity. You have lots of net income, not much in reinvestment needs. Your debt, in a sense, pays for itself, right? Because you have debt coming in, debt going out. You have big positive free cash flow equity. When you go into decline, your revenues and income might drop, but remember, you have negative reinvestment. You're divesting, cash comes in. You might have a debt outflow if you borrowed a lot of money and trying to pay it off, but generally you still have positive free cash flow equity. In fact, your free cash flow equity can exceed your net income because you're in a sense liquidating your company, making your company smaller. And liquidation, of course, you divest things, you pay off the debt, and you get whatever's left over. You can see your capacity to return cash varies across the life cycle. And companies, of course, as I said, have this choice of holding on to cash. Now, already you can see a pattern building. You're a young company, you can't pay dividends, mature growth, your free cash flow equity turned positive, but what do? You want to be young still, so you don't pay dividends. Your cash balances build up. In fact, there's a trigger point where companies wake up and say, oh my God, I'm middle-aged, I have a lot of cash, I should return it. Sometimes companies don't wake up. Somebody has to wake them up. And that's often the role of activist investors, is to remind companies that they're middle-aged and should start thinking about returning cash. Now, with that lead in, let's talk about what has actually happened with dividends. If you go back to the late 1800s, equity markets were nascent. They were just getting started. Fixed income markets were well established. Most investors, when they thought about investments, thought about buying a bond with a fixed interest rate. Here came the equity salesman. They were trying to convince people who'd invest in bonds to buy stocks. You know how they did this? They took the coupon, they tried to create stock with cash flow just like a coupon. They called it a dividend. And they promised investors that if they bought the company, not only they get the dividend this year, but they would get roughly the same dividend or higher dividend in future years. In other words, dividends became a stand-in for coupons, and companies, when they pay dividends, investors expected them to keep paying the dividends. We've laid the foundations for what's called dividend stickiness, and it persists to this day. Here's a very simple graph illustrating the stickiness of dividends. It looks at the percentage of companies each year that increase dividends, that's a green bar, the percentage of companies that decrease dividends, it's a red bar, the percent of companies that do nothing, pay the same dividend that they did each year, that's a blue bar. No contest, right? In every single year, including the worst crisis years, 2008, 2020, the percentage of companies that pay what they did last year vastly exceeds the percent of companies that increase dividends. Now that dividend stickiness basically means in most years companies pay out what they did last year as dividends. And when they change dividends, they're 2 to 3 times more likely to increase dividends than decrease them. That comes out of the dividend stickiness. And we're going to see this play out in dividend dysfunction. Dividend dysfunction comes out of the fact that many companies feel this need to maintain or increase dividends and not cut dividends. What does this lead to? Basically, it means that when you start with what you want to pay in dividends and then you work backwards. Remember in the utopian world, dividends were the last step. Here, dividends become the first step. So you decide to pay the dividend. You hope and pray you have enough cash flows from operations to do it. If you don't, you go out and borrow money to actually pay dividends, not to take projects. You actually cut back on projects just to pay dividends. And sometimes you push yourself into liquidation because you're paying so much out that you're not reinvesting back. You see why I call this dysfunction, right? The residual decision has become the driving decision. It creates dividend monsters. And it comes out of the stickiness, the fact that once you pay dividends, you have to keep paying them. And that is probably a good lead-in to look at what's happened in response. In the last 4 decades in the US, companies have shifted away from paying dividends to buying back stock. We'll look at the mechanics of what happens to companies when they buy back stock. But the trend line is, you can't contest it. You go back to the early 1980s, very few companies, even in the US, bought back stock. It was the exception. By the time you get to the late 80s, you start to see buybacks pick up. And then in the 1990s, they take off. And over the last 2 decades, buybacks have become the primary way in which cash gets returned to shareholders. So if you look across time, buybacks now account for 60, 65, 70% of the cash return. One of the things you will notice is that buybacks are much more volatile. You have a bad year like 2009, buybacks drop off. And therein, I think, lies the biggest reason why buybacks are taking over, not just in the US, but across the world, and will continue to do so. Remember we talked about the stickiness of dividends? It's 2008. You had a fiasco of a year as a company. You want to cut dividends, but you're terrified. You're terrified because dividends are sticky. Buybacks, conversely, are flexible. I think of buybacks as flexible dividends, and they actually make more sense from a residual cash flow than dividends. Of course, you could pay special dividends as an alternative. So we'll talk about the choice between special dividends and buybacks, but clearly this trend line is well established. So the stickiness of dividends has created this buyback phenomenon, and it's not going to go away. Now, if you think about dividends versus buybacks from the company's perspective, here's what happens. You have $1 billion in dividends or $1 billion in buybacks. Look at the balance sheet after the buyback, after either action. Cash leaves the company, so $1 billion less in cash. So that's gone off the asset side. And equity decreases. The only difference is how equity decreases. With dividends, it takes the form of a stock price drop on the ex-dividend day. So the price drops and you have same number of shares. In the case of buybacks, it takes the form of fewer shares and without the price drop. So if you look at the trade-off here, dividends are sticky. That once set, you're stuck with them. Buybacks are flexible. Dividends are timed. You can pay them once every quarter. Buybacks can be at any point in time. You can be opportunistic. You can do a buyback if your stock price has dropped to support your stock price, or you have a sudden windfall cash flow coming in. Dividends are paid to all shareholders in the company. And buybacks are selective. Selective in what sense? Only those people who sell their shares back get cash. That sounds unfair, but the remaining shareholders get compensated by having a higher share price on the remaining shares. So if you're a company, and if you're thinking in first principle terms with large and stable earnings, you might say, look, I'm going to go with dividends because they're sticky, but I don't care. They're time, but nothing much happens. I'm stable, and I'm paying it out to all shareholders. But if you're a company which has unstable cash flows or small cash flows and cash flows go up and down, you can see why buybacks are going to be a much better choice for you. And keep that in mind as you look at the actual numbers in a few slides. Now, of course, there's lots of misconceptions about buybacks. I don't have the time to take apart all of them, but I'm going to confront one big one. And this is used by both supporters of buybacks and people who don't like buybacks. It is that buybacks are somehow create or destroy value. In fact, buyback supporters often say you can create value through buybacks by going out and buying your own shares at below a fair value. So if you believe the fair value for your company is 100, you buy back shares at 80, it's like taking a project with positive net present value. Not really. When you buy back shares at below the stock price, you're not creating value, you're transferring value. Let me explain. Let's say your fair value is 100 and stocks are trading at 80. You go to a buyback, some people are going to sell their shares back, right? They shouldn't, but they choose to. Those people are worse off because they sold their shares at too low a price, but who gains? The remaining shareholders of the company. It's a wealth transfer or value transfer from those who sell their shares back to those who stay on. There's no value created per se. Conversely, if you're a buyback opponent, there people argue buybacks are terrible. They destroy value because companies often buy their shares when prices are high. Let's take that apart. It is true that companies often do more buybacks when prices are high. Perhaps they're buying their shares back at too high a price. Is that bad? Well, it depends. It depends on which group you look at. When you buy back shares at too high a price, you're doing a value transfer as well. But this time, from the people who stay loyal shareholders and hold on to your shares to the people who sell their shares back. Now, if you had to be loyal to a group, I would say be loyal to the group of the shareholders who stay on. So there's an argument for what Warren Buffett said he was going to follow as a rule at Berkshire Hathaway, which is he would do buybacks only if the price is less than the intrinsic value. But even there's no value creation, there's a value transfer. So with that lead in, let's look at the actual cash returned in 2024. So what I've done here is I've broken down all global companies into sectors and looked at the cash return, both in the form of dividends and buybacks by sector. And there are really no surprises here. The biggest dividend paying sectors are real estate and utilities in terms of percentage of net income return. In terms of dollar dividends paid, no contest at all. It's financials, banks, insurance companies, investment banks. If you look at the number, $620 billion in cash flows returned. You know, it's only, if you think in terms of percentage, it's only 32% of the net income, but it's basically a lot of cash returned. Collectively, global companies paid out $2.55 trillion in dividends. What are the lightest dividend paying sectors? Technology pays out only 30% of its net income in dividends and only $204 billion. You're saying only $204 billion? Remember, in terms of market cap, technology is the largest sector. So across sectors, you see variations in dividends. The second set of numbers relate to buybacks. The biggest buyback sector is technology, $280 billion. And that should make sense, right? Because remember in the trade-off we said, if you have large and volatile earnings, you're more likely to do buybacks. There's a rhyme and reason to what's happening here. The bulk of the cash does get returned by money-making companies, and you can compute a payout ratio only for the money-making companies, but there are money-losing companies that not only pay dividends, but buy back stock. Sounds completely irrational, but we'll come and look at good reasons why that might happen. But basically, you can see across sectors the variations in cash return. I was also interested in whether there was a variation in how much cash was returned across regions. If you look across regions, you can see that the US kind of stands out in terms of the percentage of cash flows that get returned in the form of buybacks. Among money-making companies in the US, where the bulk of the cash is returned, almost 60% of the cash flows returned took the form of buybacks. And in terms of dollar value, U.S. companies accounted for almost 2/3 of the cash returned across all companies in the form of buybacks. Clearly, buybacks have the deepest and strongest roots in the U.S. But if you look across the rest of the world, you can see that it's starting to pick up in other parts of the world. So you can see that this notion of buybacks, which used to be foreign to most non-US companies, is starting to catch on. You can look at the UK, you can look at Canada. Now, there are markets where you can see that the cash return is relatively paltry. In fact, take a look at the last column where I look at the total cash returned by grouping. So if you look across every part of the world, the part of the world where you have the most cash returned is the US, the UK. You can see the mature markets, Australia, New Zealand. The part of the world where you get the lowest percentage, and it stands out, is India. Only 31% of net income gets returned in the form of either dividends or buybacks. Now, you can take a benign view of that and say India is a high growth market, companies should be reinvesting. That is true. But it could also be a corporate governance issue because remember, managers set dividends. It's a discretionary choice, and if they feel no pressure from shareholders, they would return less cash. So again, read into the differences what you will, but clearly big differences in cash returned across parts of the world. Which brings us to, are these companies doing the right thing? Are they returning what they can? And I'm going to start with a big picture perspective on cash return. What I've done here is looked at the global free cash flow equity across all firms. I added up the net income, the net capex, the change in working capital, all those things you need to get to free cash flow equity. And collectively across all firms, the free cash flow equity is about $1.6 to $1.7 trillion. That's a lot of free cash flow equity, cash available to return. But if you look at what companies actually returned, it's 2.55 trillion in dividends. On top of that, you have another 1.5 trillion in buybacks, more than 4 trillion. Collectively, companies return more in cash than they had coming in. Where did they come up with the extra cash? Remember, existing cash balances can be used. You can have new. So there are lots of things that could explain that difference. But clearly, companies are returning more cash. I took a closer look at what I call mismatched companies. Earlier, we talked about net income being negative and companies paying dividends, or net income being positive and companies not paying dividends. So what I did here is highlighted two groups based on dividends. I looked at the percentage of money-making companies that don't pay dividends. Collectively, about 31% of money-making companies. The way you can get that is you take the 69% of money-making companies pay dividends, 31% don't, and ask, why might money-making companies that sometimes not pay dividends? The first is inertia. That's going to show up over and over again. We've never paid dividends. Why should we start now? The second is, remember that these are, some of these companies could be young companies. They're making money, but they want to grow. It could be that they're investing for growth. The third could be that they have money right now. It could be a commodity company. It's making money, but that could be volatile. It could change. And the fourth is that if you're a company that's never paid a dividend, when you initiate a dividend, you're sending a signal to markets that growth is leveling off. This year, Facebook and Google both initiated dividends. What were they trying to do? In my view, they were signaling, we're grown-up companies now. Don't come to us as investors expecting 25% growth. Why would money-losing companies sometimes continue to pay dividends? Again, inertia. We've always paid dividends, and just because we're losing a few billion doesn't mean we're going to stop. The second is signaling, and this is a problem with signals, is they can cut both ways. When you cut dividends, you're sending a signal that things are really bad, and people worry about, or CFOs worry about that signal. The third is, remember we talked about earnings being volatile, that in a good year you might not pay dividends. Conversely, if you have volatile earnings, your earnings might have dropped, but you expect them to bounce back. And the fourth is, you might be in a sector where everybody pays dividends and you don't want to be the odd man out. That's on dividend policy. Then I took another mechanism to look at companies. I looked at the free cash flow equity potential dividends, and I looked at cash returned by the company in the form of dividends and buybacks. And again, I'm going to focus on the exceptions. You have companies with positive free cash flow equity. They should be paying a dividend. 62% either pay dividends or buy back stock, so they're returning cash. But 38% of companies with positive free cash flow equity don't return cash. So I stopped right there and said, why might a positive free cash flow equity company, remember this is cash left over after you've met all your growth needs and reinvestment needs, why might they not return cash? Again, inertia might be the answer. We've never returned cash. We're not going to start now. The second again is your free cash flow equity could bounce around. You're worried that it might become negative. The third is that you have a lot of debt and you need to pay that debt down, and you're going to use your free cash flow to do that. And the fourth is you're holding cash just in case you want to expand into new business. You want to invest in AI. Among negative free cash flow equity, remember we said these companies should not return cash. 48% of these companies do return cash. So I said, why would negative free cash flow equity companies sometimes return cash? Again, it's inertia. We've always returned cash. We're not going to stop now. This notion of volatility, but in the other direction, that they're going to bounce back. They're negative right now. The third is, you might want to go out and borrow money. So basically, you're using that borrowed money to pay your dividends because you want to increase leverage over time. Completely rational if you think about, being an underlevered firm. And the fourth is, sometimes companies want to make themselves smaller because they're in a bad business, it's not working, and paying out more than you have as free cash flow equity lets you get there. What I'm trying to present in this picture is don't be too quick to judge a firm. Sometimes companies might not do what you expect them to do for really good reasons. One final slice and dice that I did was I took companies by age. If you remember the corporate life cycle argument, and I wanted to see whether there was some basis to the argument. So I took global companies, all 48,000, and I classified them by corporate age, from youngest, that's the bottom decile, to oldest, top decile. And there are roughly about 4,000 to 5,000 companies in this group. First, I looked at the percentage of companies in each group that's money losing. Let's focus on that column. 69% of the youngest companies are money losing, and that ratio, that statistic drops to 17%. So younger companies are far more likely to be money losing than older companies. And not surprisingly, that plays out in the dividend decision. Only 18% of young companies pay dividends, 78% of the oldest companies do. Already you can see if you have an investment philosophy where you need dividends from a company to actually invest in it. It's not a bad philosophy, but it'll get you older companies in your portfolio. I also looked at the percentage of companies with negative free cash flow equity. They're in a hole, right? 72% of the youngest companies have negative free cash flow equity. Only 44 companies. I was actually surprised that 44 companies, the oldest companies, have negative free cash flow equity, but some of them might be in bad businesses. Their free cash flow equity started, or they've borrowed a lot of money and they have debt payments. But that ratio does drop as you get from younger to older. And not surprisingly again, only 28% of the youngest companies buy back stock. And that ratio is 82% for the oldest companies. Already you can see the corporate life cycle play out in the dividend decision. So what's the bottom line here? Well, dividends are meant to be for residual cash flows. They've taken on a life of their own because of the way they've evolved into becoming sticky. And as a consequence, changes in dividends become signals, and companies often adopt dividend policies that are dysfunctional, that are at odds with their capacity to return cash. At the risk of repeating what I've said all through, the two forces that feed dividend dysfunction, the first is inertia. Companies often keep doing what they've always done when it comes to dividend policy, which also becomes a problem as companies go through the life cycle because they're doing something that made sense when they were a young growth company, but they're now a mature company. So I compliment Facebook and Google for being adaptive, by being proactive on dividend policy. The second is Me-tooism. And I blame analysts and investors as much as companies, because analysts look at companies and say, everybody else in your sector is returning cash. Why aren't you doing it? Well, that's going to encourage Me-tooism. I hope you found this session useful, and I thank you very much for listening.